Ladies and gentlemen, good day and welcome to the Q3 and 9 months FY23 results conference call of the Phoenix Mills Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Management of the company is being represented by Mr. Shishir Shrivastava, Managing Director, Mr. Anurag Shrivastava, Group CFO, and Mr. Varun Parwal, Deputy CFO. Should you need assistance during this conference call, please signal an operator by pressing star followed by 0 on your touchtone phone. Please note that this conference is being recorded. At this time, I would like to hand over the conference to Mr. Shishir Shrivastava. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. Thank you for joining us today, and we take pleasure in welcoming you all to discuss the operating and financial performance of the third quarter and first 9 months of FY23. I hope you've had a chance to look at the results presentation shared by us. The same is uploaded on the stock exchanges as well as on our website. We will now take you through the key highlights of the results and will refer to relevant sections of the results presentations from time to time. We will now start with the performance of our retail portfolio. May I draw your attention to page 4 onwards of the results presentation. Consumption in Q3 FY23 stood at 2,647 crore, showing a growth of 28% over Q3 FY20, which was historically our best year. Excluding Phoenix Palacio, Lucknow, and Phoenix Citadel, Indore, the growth was 14% of Q3 FY20. Consumption was robust across categories in the third quarter. Some of the top performing categories were jewelry, which was up 142% from Q3 FY20. Electronics up 21% from Q3 FY20. Fashion and accessories up 26%. Food and beverage up 31%. FEC, multiplex and entertainment up 30% from Q3 FY20. Turning to page 5, consumption in 9-month FY23 stood at 7,037 crore, up 20% compared to 9 months FY20. Excluding Phoenix Palacio and Phoenix Citadel's contribution, growth was 14% compared to 9-month FY20. Retail collections for 9-month FY23 stood at 1,585 crore, making the quarterly average run rate of over rupees 525 crore per quarter. Moving to page 6 and 7. January 23, we saw consumption at approximately 816 crore, which was up 27% compared to January 2020. At Phoenix Palladium, 2 of our key stores, Zara and Reliance Digital, are undergoing renovations. Zara is recreating a flagship store with a much larger GLA and is currently not operational since January 1st. This has had a negative impact of about 8% on consumption growth at Phoenix Palladium, a 3% impact on consumption growth on a like-to-like basis, and a 2% impact on overall consumption growth. YTD, April to January 23, we achieved consumption of approximately 7,853 crore and are on track to cross annual consumption of approximately 9,000 crore. Any bump up on account of new trading areas becoming operational inside existing malls at Chennai, Pune, Kurla, sustained consumption growth in existing malls, and new mall opening at Ahmedabad in this month, and consumption growth at our latest mall, Phoenix Citadel, Indore, will account for an increase beyond the 9,000 crore estimate. We have had a robust event calendar for each mall, with major spike events scheduled for weekends and engaging mini spike events during weekdays. We continue to invest in innovative, eye-catching decor across properties and bring in the best of brands and categories and fine dining, food and beverage experiences. We gear all of these activities towards making each mall the de facto destination for consumers. Turning to page 10 through 13, we have some photos depicting the beautiful interiors at our recently launched Phoenix Citadel Indore, which is the largest mall of Central India with a GLA of 1 million square feet. Phoenix Citadel currently has a trading occupancy of 50%, up from 42% in December, and we are on track to cross occupancy of 85% by March 2023. The trading density for this month was in the range of rupees 700 to 800 per square foot per month, and we expect to reach approximately 1,000 rupees per square foot per month in FY24. Please turn to slide 14 onwards for an update on our upcoming malls. I'm happy to announce that we are set to launch Palladium Ahmedabad later this month with a retail GLA of approximately 770,000 square feet. This mall is 99% leased as of January 23. This will be followed by the launch of Phoenix Mall of Asia at Bangalore and Phoenix Mall of the Millennium at Pune in Q1 FY24. Phoenix Mall of Asia Bangalore has a retail GLA of approximately 1.2 million square feet and has achieved leased occupancy of 87%. Phoenix Mall of the Millennium Pune has a retail GLA of approximately 1.1 million square feet and has achieved leased occupancy of 88% by January 23. At our retail project in Calcutta, we have completed the demolition work for the old on-site structures and currently piling and diaphragm work is in progress. At Project Rise in Lower Parel, shore piling work has been completed. Rock anchoring excavation is in progress. Moving on to offices, our phase 1 of offices at Bangalore, part of the Mall of Asia development. We have a GLA of approximately 800,000 square feet in the first phase, and the RCC structure of the towers are completed. We are in advanced leasing discussions and expect to operationalize the offices in the first half of FY24. Moving on to other office projects, design work has been completed for both Palladium offices at Chennai and Millennium offices at Wakad, Pune, with a target completion in FY25 for both. In case of Millennium offices, construction has commenced for 2 out of 4 towers, and for Palladium offices at Chennai, slab casting has commenced on the top of the mall podium. Excavation and shore piling is underway for our retail and office expansion at Phoenix Market City, Bangalore. As we make fast inroads in Gujarat and with the launch of Phoenix Palladium Ahmedabad later this month, we also completed the acquisition of a 7-acre land parcel in Surat in December 22 to develop a premium retail destination for customers. Now moving on to our performance of our retail portfolio from page 25 onwards. In line with consumption, our rental and EBITDA growth has also been strong. Q3 FY23 retail rental income was approximately 336 crore, up 21% compared to Q3 FY20. Retail EBITDA for the same quarter was rupees 339 crore, up 29% compared to Q3 FY20. In the first 9 months of FY23, our retail rental income stood at 972 crore, showing a growth of 22% over 9 months FY20. And retail EBITDA stood at 982 crore, showing a growth of 28% over the same period FY20. Page 33 gives you a status on leased occupancy, trading occupancy, and trading area. We have seen a significant ramp up across these 3 parameters vis-a-vis June 22. May I now request Anurag to take you through the office, hotel, and residential section and overall financial results.
Thank you, Shishir. Good afternoon, everyone. Please refer from page 35 to 37 for an update on our commercial portfolio. Our commercial office portfolio continues to demonstrate a strong leasing traction. For the period of April to January 2023, we saw gross leasing of 3.95 lakh square feet, of which 2.45 lakh square feet is the new leasing and 1.5 lakh square feet is the renewal. Total office income for quarter 3 FY23 stood at 42 crores, up 16% year-on-year. Total EBITDA stood at 23 crores. Collection efficiency for the quarter was at 96%, and we collected about 55 crores. During 9 months of FY23, office income stood at 126 crores, was up by 10% year-on-year, and EBITDA was flat year-on-year at 71 crores. Collection efficiency for the 9 months was at 98%, and we collected about 146 crores in this part of our business. For update on hotels, I'll request you to please refer to page 39 to 44. At both our hotels, we have witnessed strong improvement on account of social and corporate events, pickup in F&B and the festive season, which has led to the higher occupancies and the ARRs. At the St. Regis, during January 2023, our ARR stood at 17,765 and RevPAR at 14,786, showing significant improvement over the same period last year. The operating performance at St. Regis, Mumbai has surpassed most parameters in last 9 months, led by resumption of foreign travel, domestic corporate travel, social events and staycation. These factors provide an excellent visibility for high occupancy and ARRs in the coming months. Total income stood at 109 crores, up 13% from quarter 3 FY20. Occupancy for the quarter stood at 81% and ARR was at 16,392, up 18% as well. Operating EBITDA came in at 49 crores, which was a 21% growth compared to quarter 3 FY20. At Courtyard by Marriott Agra, total income stood at 14 crores, up 13% from quarter 3 FY20. Occupancy for quarter 3 FY23 was at 79% and ARR at 5,610, up 14% from quarter 3 FY20. During the month of January, Courtyard Marriott RevPAR stood at rupees at 4,125. Moving on to residential business update, please refer to page 46. We are witnessing very good traction in residential sales, mainly led by robust demand of ready-to-move-in inventory and faster conversion. We achieved overall sales of 104 crores in quarter 3 FY23, of which 14 crores worth of sales pending registration. Momentum in sale continues, with sale of rupees 275 crores in the period from April to December 2022. Further, we have now crossed a sale of rupees 300 crores if we take the first week of February also into consideration. Collections in quarter 3 were at 129 crores and 9 months at 254 crores. We are following through our strategy on marquee residential projects in mature markets, and we are pleased to announce that we expect to close the acquisition of very prime 5.5 acre land parcel in Alipur, Kolkata for consideration of 430 crores. More details to follow on this account in the coming quarters. I would request you to turn to page 48 to 51 for our financial results. Some of the key highlights of our consolidated financial performance are as follows. Income from operations for quarter 3 FY23 was at 684 crores, up 66% year-on-year and 34% compared to quarter 3 FY20. Income from operations at 1909 crores for 9 months of FY23, up 93% year-on-year and 24% compared to 9 months FY20. EBITDA for quarter 3 FY23 at 384 crores, up 67% year-on-year and 48% compared to same quarter FY20. EBITDA at 1088 crores for 9 months FY23, up 121% year-on-year and 43% compared to 9 months of FY20. Reported PAT after minority interest and before comprehensive income for quarter 3 at 176 crores, up 78% year-on-year and 92% compared to quarter 3 of FY20. Same numbers for 9 months, PAT at 1081 crores compared to 133 crores for 9 months FY22 and 288 crores for 9 months of FY20. I would now move to cash flow, debt and liquidity position and would request you to refer pages 52 to 58. For quarter 3 FY23, we generated 419 crores of net cash from our operations and our operating free cash flow adjusted for tax stood at 339 crores. For 9 months period, our operating cash flow stood at 1,152 crores and our free cash flow stood at 911 crores, which has surpassed our FY22 numbers of rupees 501 crores. Our capex for the quarter was 775 crores. The pace of spending has picked up as 3 of our under construction malls enter into their final phase of completion. As mentioned earlier, Palladium Ahmedabad is set for launch later this month, and Phoenix Mall of Millennium and Phoenix Mall of Asia are set to commence operations in first quarter of FY24. Moving on to our debt numbers on page 55. Consolidated gross debt, which stood at 3,953 crores as on 31st December 22, showed a decrease of 311 crores from rupees 4264 crores as on 30th September 22. On the operational portfolio, there has been a decline in debt due to gradual repayments as well as few planned repayments that have been done during the quarter. At Phoenix Citadel, Indore has become operational. The debt has been moved to operational asset, as a result of which the under construction portfolio has witnessed a decrease in debt. Average cost of borrowing is up 52 bips to 8.41% in December 22 from 7.89 in September 22. Currently, our lowest cost of borrowing stands at 7.35%. Despite RBI increasing rates by 225 bips since March 22, our borrowing costs have gone up only by 111 bips so far. As the overall interest rates in the economy start to rise, our effort will be to minimize the impact of this on our cost of borrowing by reducing the spread charged by the banks on top of the repo rate. Moving to liquidity on page 57. Our liquidity position as on 31st December 22 was 1,863 crores. This excludes rupees 1285 crore in unutilized OD accounts. At a group level, our net debt position is 2,090 crores and PML's share of net debt is 1,550 crores. We are bullish on our business prospects, and with a strong balance sheet position, our focus is now to deliver on our under construction projects in time and judiciously deploy our capital to expand our portfolio. Last but not the least, I am pleased to announce our foray into warehousing through our recent acquisition of a land parcel measuring about 33 crores at Sona NCR. The acquisition cost of this parcel was about 53.2 crores. With this, we would close our opening remarks and will open the call for an interactive session and question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Puneet Gulati from HSBC. Please go ahead.
Thank you so much for the opportunity. My first question is, with respect to the two malls, Kurla and Chennai, which seems to be lagging behind the others. Can you comment on what's happening there and what steps are you taking, and when should we expect them to come back to normal sustainable levels?
Hi Puneet, Varun this side. Thanks for
Thank
your
you.
question. Kurla, I would say that if you see the January consumption, we are seeing a recovery in the numbers in Kurla. We have undertaken a relook at the brand mix, and we have opened several new stores, which has helped freshen up the brand category mix in Kurla. We also have the first Uniqlo store in Mumbai, which is under fit out at this point in time, and that would also add further to help draw customers to Kurla. Secondly, I think we are also stepping up our spike events both over the weekends as well as during the week to ensure that we continue to establish Kurla as a go-to destination as people increasingly come back to offices. I think January has seen a turnaround, and going forward in the coming months, you should continue to see a turnaround. Going to your second question, which is on Chennai.
Yeah.
Chennai, as you're aware, we had a significant amount of renewals that were lined up in Chennai, and as part of that, we have been phasing out some of the non-performing retailers, both even in Q3 at this point in time. Now, several new stores have opened up, and you will see their positive impact on consumption coming through as we go through the rest of the month in this year.
Okay. And when should they ramp up? Yeah, sorry.
Yeah, just to add, this is Anurag. I think there has been a decent increase in trading occupancies on both malls. I think we were in middle 80s a couple of quarters back on both the malls, and both these malls have moved in early 90s in terms of trading occupancy. Also, I think there is a healthy growth in trading density in both these malls. I think it's just a question of time as these malls catch up to the other malls in terms of trading occupancy. We will have the similar numbers on consumption.
Okay, and rentals should follow the same, I presume, because they're still lagging a bit compared to consumption.
I think if you see Kurla, Puneet, rentals at Kurla have increased to 118 rupees compared to about 108 that they were pre-COVID.
Yeah, but no, Kurla is still okay. Chennai, I mean, if I look at Y&Y rentals, they're still 14% despite consumption up almost 20% Y&Y. So they're still to be lagging behind a bit.
So Chennai also, I think if you see the rental rate, Puneet, that has gone to 159. Now, as the trading occupancy ramps up, you will see a positive impact happening on the rental income and the asset EBITDA as well. Right now, it's flat compared to the pre-COVID period, but that's also because that the trading area is about 9% lower than what it was in the pre-COVID period. So with the new stores and, we have a very active Instagram profile for all of these assets, and I encourage everyone to follow it because you will get far quicker updates on the new stores that are opening up at each one of these centers. And Chennai has seen a lot of new stores opening up in January.
Understood. That's helpful. My second question is on your new malls, both Pune and Bangalore. Now you're indicating to start in first quarter of FY20, so by June, and there is still almost 400 crore in my view that needs to be spent there. Is there enough? Is there reasonable certainty that they will start in 1Q, or is there a risk of them getting pushed out to 2Q? And following up on that, how soon should we see them ramp up to 90%? For example, Indore, now you're guiding in 4 months you'll be 80%. How soon will these malls reach about 90% in trading occupancy?
So I think first, if you see Indore is started at 42% occupancy and it has gone to 50% today, and I think we are looking at it crossing 85% by March 2023.
Correct.
Even in Indore, there is a bit of retention money that is held back, and that is a figure of about 48 crores, which is there.
Okay.
Right, and this retention money is typically spent or released rather within 12 months of the mall getting completed.
Okay.
So when you look at Pune and Hebbal as well, right now our monthly spending run rate here is going to be at about 60 crores a month in the two malls combined. So by the time they open up, we would have spent another 250 to 300 crores. So the balance amount that would be left with us would be about 100 to 120 crores, which is very typical for an asset of this size, Puneet.
Okay. And ramp up, should we expect similar 4 months, these malls going up to 85% level, or are these different in some sense?
See, our typical guidance is to ramp up to 85% plus by within 12 months, right? And we have seen a significantly, aggressive ramp up and a very positive ramp up in both Lucknow and Indore. And fingers crossed, our teams will endeavor for the same show and even a better show in for Pune and Bangalore as well.
Understood. That's okay. Last one on the residential. Have you paid anything for Kolkata Alipur land?
Alipur land parcel.
Yeah.
Have we paid anything?
No, we haven't paid anything as yet. Only I think an initial amount of about close to 5 crores we have paid. The balance payment will go out in this quarter, and I think the formalities are underway, and we should be acquiring that land parcel soon.
Okay. And how much is the balance?
432 crores.
432. And what would you need to spend to build it up fully? Any estimate you have at this point of time?
I think very rough estimates is very initial, and it will depend on the kind of project and how it will go, but roughly about, I think in ballpark of 1,000 crores.
Okay, 1,000 crore additional construction cost.
1,000 is total, Puneet.
Total. Okay.
Yeah.
Including land cost. Yeah. That's great. That's all from my side. Thank you so much, and all the best.
Puneet,
Thank you.
this is Shishir. Just to
Yeah, hi Shishir.
Hi. While we have 1,000 crore of total estimated outflow on this project at Alipur,
Yeah.
I think we will need to fund only about 20% of the construction cost, because balance will get funded from sales.
Okay.
So 500 odd crore of construction. About 120 is what we will require to fund initially before the project goes into, sales, and the collections from there will fund the balance.
Okay. Understood. Yeah.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah. Thanks for the opportunity. First question is on, the retail rental income for this quarter. While, consumption growth was roughly 25-26% quarter on quarter, but, our retail rental growths were 7%. And even if we compare, the ratio of retail income to consumption, that's at 13% versus on an average it has been 14-15%. So anything to read into, or this is, not supposed to be followed on a quarterly basis, but over the period. So if you can just highlight.
Yeah. So I think our overall guidance on a number is, we've been growing at a CAGR of about 15-16%, mid-teens, and I think we continue to be on that trajectory. The consumption increase vis-a-vis rental increase, I think there are a couple of things. I think it largely also depends on the category which is growing in consumption. Like for this quarter, we have seen jewelry on a much higher growth rate than in the other categories, because it's a festive season and wedding season and those kind of things. So quarter 3 jewelry tends to be on the higher amount. So that is one aspect. Second is, I think our revenue share is about 15-16%. Between 12 to 15%, and proportionate amount will only fall down to our rental increase, which we are seeing this quarter as well. So broadly, these two are there. There's nothing. I'll say there's nothing much to read into this. I think this is business as usual. And on an overall basis, I think our guidance remains intact of those numbers.
Sure, got it. Secondly, on office, so we have had a good leasing at least in January for Fountainhead Tower 3. What sort of timeline we built into to basically fully see full occupancy in that project? And since we are completing our Bangalore Asia offices in first half FY24, any pre-leasing that we have done till now, or what's the timeline that we are looking there as well?
Yeah, hi, this is Shishir.
Hi, Shishir.
For Fountainhead Towers 2 and 3, we have a fairly good pipeline in sight. We would expect to see by the end of FY24, we should be at about a 90% leased occupancy. And we are seeing visibility of being at Fountainhead Tower 3 reaching about 50% by July or August of this year. So there's a decent pipeline in place. We've ramped up the team. We've got some very, very good senior members on board now across our leasing teams. Bangalore Asia Towers, we expect the OC sometime around June or July of this year. And again, we have about 870,000, 880,000 square feet of GLA there. All the RFPs where we are engaged with and other requirements that have come in, we've seen approximately 30 lakh or 3.5 million square feet of visibility, which is part, and we are engaged with potential tenants there. So we remain very optimistic seeing the bounce back in demand, which is arising out of, the confidence is coming out of the RFPs which are in the market.
Thanks, that's very helpful. Just lastly on Citadel, the rentals, if I see they're at 114, 115 per square feet, while we have earlier guided around 9,500 per square feet. Is it that initial mix has a higher rentals, and probably when mall fully stabilizes, we'll get back to 9,500 kind of a per square feet rental, or do we see this rentals continue for that asset?
Sorry, which asset are you referring to in the retail?
Citadel Indore.
So we had originally underwritten our business plan, I think at about 85 rupees.
Yeah.
At about 85 rupees. I think we should be somewhere in that range of about 95 to 100 only. So I didn't quite understand your question. Did you say that the average?
I said rentals are right now higher at 114 is what you have mentioned in the presentation. Versus we had underwritten at lower. So should we consider 114 as the normalized rental run rate for that asset?
Yes, your analysis is correct. That it's basis the current mix. As the mall gets occupied, more of the anchors open, we expect it to stabilize in that range of about 95 to 100.
Okay, got it. That clarifies. Thanks. That's it from my side. I'll jump back in the queue for more questions. And all the best.
Thank you. We have a question from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi. Good afternoon. Thanks for taking my question. My first question was on, this month actually, Jan, we've seen some extended, end of season sales both in the physical and online format. Pressure on retail.
I'm sorry, Mr. Lakhan, your voice is breaking. It's coming muffled.
Am I audible now?
Yes, please go ahead.
So what I was asking was that we have seen extended end of season sales from retailers both in physical as well as online format. So are we seeing some pressure on retailers in that context, and also any segment that you may want to highlight is seeing more pressure than others?
Kunal, I didn't quite understand your question. I got the part that it's you've seen an extended end of season sale in the month of Jan, both online and offline. I didn't understand the question pertaining to the pressure on the retailers.
So how should we read this whole extended end of season thing? Like, are retailers seeing more pressure in terms of offloading inventory, or parallelly, is there any slowdown in the discretionary consumption side?
No, not at all. Not at all. In fact, that was the concern in December. But looking at Jan performance, I think the demand continues to be sustained, and we continue to drive that demand through our innovative marketing. So previously, the end of season sales used to be, I think, from 10th of December to 14th of Feb, typically. And presently, in fact, the duration has shortened. It's from 20th of December to 30th of Jan.
Okay. So you're not seeing any slowdown in the discretionary consumption side?
No, we are not seeing any slowdown in the discretionary consumption here. And if you also look at specifically, I would say that jewelry at 142% growth, we are also trying to understand what the drivers are. As Anurag mentioned, it's on account of perhaps a lot of the wedding season being an extended period. But if you look at the other categories of discretionary spend, whether it's F&B or fashion and accessories, electronics, they've all shown significant growth, even entertainment for that matter.
Sure. My second question was on the Alipur land. So this is not under any platform, right? This will be done by us, right?
Yes, it's 100% under a subsidiary of under a 100% subsidiary of Phoenix Mills that we are developing it.
Sure. So just wanted to understand the thought process here, because that's a lot of capital to be deployed there, right? Almost 900 crores from our books, and some part getting funded by pre-sales. How are we thinking about this? How should one read this, like in terms of our strategy going ahead? Because if we, historically we've been a mall developer and operator, but now incrementally we are seeing a lot of capital getting deployed into newer business segments. Should one read that the incremental opportunities in the tier 1 cities that we are targeting are getting fewer and fewer? Or is it like a conscious strategy for us to diversify our business? How should one read this?
Yeah, I think in the last year we have actually on multiple occasions stated what our strategy is, both on the residential side and on other businesses such as warehousing. To reiterate that, as far as Resi is concerned, our stated strategy has been to look for opportunities in mature locations which are usually value accretive, where a product similar in format and quality would be like a One Bangalore West, which we already have. And accordingly, we've gone and acquired, or we are in the midst of concluding the conveyance on the Alipur land parcel. That immediate neighborhood or that market has typically seen sales at a rate of about 18,000 to going up to 21,000 for good quality projects per square foot. So this is really the kind of micro market where we would like to build out residential. The reason why we did that, of course, was, again, as I've explained in the past, this has been a learning through COVID, where retail income had actually come to a halt, but the office business and the residential business supported our cash flow. So we want to have some diversification of risk. So it's in line with our strategy of marquee projects, iconic residential developments in mature markets.
Sure,
having said that, the mall business itself continues to grow, and we continue to focus on the key markets that we have identified in the past. We have checkboxed Kolkata and Surat in that, and we are actively looking for opportunities in other markets.
So the way I'm reading it is like you're not seeing any dearth of opportunities in tier one towns as such. Like, it's just a conscious strategy of deploying this capital or diversifying our portfolio.
Visibility of cash flows, as I think you've seen that we are at a approximate 900 crore of free cash flows in the 9 months of this financial year. So if one looks at about 1,200 crore kind of a free cash flow this year, going to about, we would estimate 1,600 or 1,800 crore in the next year, we have a capital deployment strategy in place. And Anurag and Varun will delve into that deeper in a short while. If you'd like to move to your next question.
My last bit was on the warehousing side. Like, yes, we've made that foray with a small deployment of capital. But in the long run, like, what is the strategy here, and how big this can be, and what kind of capital you can look to deploy in the next 3 to 5 years?
Okay, warehousing. The whole idea started with providing quality warehousing space because our retailers had a demand in cities where there isn't good quality warehousing real estate available. So we are focusing on those markets to start with. I think as we've progressed and we've concluded the first acquisition in NCR, and the demand, the pipeline that is being built for this location, it does appear to be an extremely attractive business. For the present, we are looking at deploying our own capital to grow it to a certain point to fulfill the needs of our retailers. Approximately 300 to 350 crore is what we expect to spend from our own pocket before we decide to probably expand that business by way of bringing in a financial partner.
Sure. That's helpful. Thanks and all the best.
Thank you. We have a next question from the line of Mohit Agrawal from IIFL. Please go ahead.
Yeah, thanks. So my first question is, where are the footfalls across your malls? So I think last quarter that number was in that 85 to 90% range. So have they recovered back to 100%?
This last quarter, we should be close to about 100%, yes. At some locations, it may be even higher. Bangalore, for example, may be about at 115%.
And what do you think will lead to that growth from here? And if you could also elaborate what segments were earlier lagging, which have recovered, and what segments are doing fine across your malls?
When you say growth, are you referring to, is this a continuation to your question on footfall growth, or is this growth of?
Yeah, footfall. So I mean to suggest that, do you see the footfall growth and the consumption growth kind of converging, or do you see the gap between, let's say, you see 127% consumption level? Do you see 127% versus 100% to kind of that difference to sustain? How do you see that going forward?
So let me just clarify that our focus is consumption. So I'm not going to delve into footfalls. Everything that all the marketing initiatives that we undertake is to drive that correct profile of footfall to our mall. But the focus is consumption and a growing ticket size per person. So consumption growth, we have always said that once we are back to pre-COVID levels and beyond, one can estimate a 15 or whatever mid-teens growth annually, and I think we should be on track with that. Okay. And your next question was it on categories? Were you referring to
categories? Which ones have? So my question was actually on footfalls. Which categories have turned around? Which were going slow when we were at 85%, and now which one have recovered?
Of late, we have seen a significant growth in the entertainment bit, which is family entertainment centers and multiplex, which in this quarter compared to Q3 FY20 has shown a 30% growth. We expect that this may in the subsequent quarter also grow further because this quarter again there's a good lineup of content, and of course the summer will also bring in a lot of content for multiplexes. So we expect that also to grow. Supermarkets and hypermarkets have shown a degrowth, but that may be more on account of specific brand related issues, which we are trying to fix. But our dependency on the hypermarket or supermarket business contribution to rental is only 1%.
Okay, understood. Okay. My second question is on the GIC platform. So it's been about 2 years, and we've recently added the Surat asset. How do you see the progress in this? And because initially we had said that there is a within 3 to 5 years, we might do a REIT. So what are your thoughts on that? Given the progress that we've seen in the last 2 years. And are we still looking to do a REIT, and especially considering post-budget changes, what are your thoughts on that?
So the GIC joint venture platform is on track. We are also looking at a significant expansion potential both at Mumbai, in Phoenix Market City, Mumbai, and at Phoenix Market City, Pune. So we are working on the plans for that expansion. Beyond that, we are actively looking for opportunities for one more mall to be added immediately in that joint venture, which we hope in the next quarter or so we should be able to secure some opportunity there. Moving on to your question on REIT, I think one has to wait and watch. There have been some regulatory changes. We already have a retail REIT which is on the road. We would like to see the performance, and that we will take that decision depending on how value accretive it is for us in terms of being a capital source.
Okay. And when you talk about expansion in Mumbai and Pune mall, is it utilizing the unused FSI in this, or is it talking about some redevelopment opportunity within that asset?
Hello, sir.
Can you hear me?
Yes, we can.
Would you like me to repeat that?
Yes, please.
So the answer, the answer was that it is to utilize the additional FSI potential available under the current regulations.
Okay, understood. Thanks a lot. That's all from my side.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to answer queries from all participants, kindly restrict your questions to 2 at a time. We have a question from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Hi, Shashir. Congratulations on a decent quarter. So my first question is, in this quarter, the contribution of rental from revenue.
Please use your handset. Your audio is not clear.
In this quarter, how much is the contribution from the revenue share?
It's approximately 13%. If you look at the overall rental income as a percentage of consumption, we are at about 12.5 or 12.6%. The incremental revenue share over and above the minimum guaranteed rental would also be in the range of about 12 to 13%.
Okay. Shashir, you mentioned about this new business BD addition of one more mall. So if you can highlight how is the business development pipeline again, refresh us, and also what could be the incremental FSI potential in
You're not very clear. May I request you to bring the phone closer?
Yeah, is it better now? Hello, can you hear me?
Yes, this is much better.
Yes, I was saying, within the business development pipeline, how is it looking now in different regions? Again, on the FSI side, which you said on 2 malls, so what could be the incremental FSI potential in these 2 malls?
So, we've in the past we've explained how we are looking at Jaipur, Chandigarh, NCR, Navi Mumbai, Hyderabad, and Thane as opportunities. And we are actively engaged in 4 of these markets today on opportunities. And we were also evaluating Nagpur, Goa, and Visakhapatnam as the next priority set for us.
And the FSI potential in these 2 malls, which you're looking at?
Sorry, sir, you're not audible.
Okay. Okay, I'll join back with you. Thank you.
Thank you. We have our next question from the line of Niket Shah from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity. I just had one question. Given the kind of cash flow that you are generating, this year and next year, you will effectively be ending with, say, roughly about 500-600 crores worth of net debt. What do you plan to do with such massive cash flow generation, going forward?
Yeah, this is Anurag. So if you look at our cash generation and the uses, we still have about 4.5 to about 5,500 crores to be spent as capex on our existing line of expansions and new malls, etc. So that should consume a significant amount of cash. Then we are, as the earlier caller had asked, we are planning to expand in some of the newer cities as well. So we expect to acquire 1 to 2 land parcels every year at least. So that will take up about, 1,000 crores of cash per year for that. So that takes up the most of the cash which we are generating. We don't expect to increase the debt significantly. We tend to be on the similar levels. But these are the requirements which will be there. And of course, we are very minimum amount of cash going in, let's say, in warehousing a project here and there or resi. But that will be just, 10-15% of our overall cash deployment. So these are the uses of cash. I think the story continues as usual. Focus on retail and 80 to 85, 90% cash will be utilized there, and balance in other areas.
Got it. Yeah, perfect. Thanks. I'll come back.
Thank you. We have a next question from the line of Vasudev Ganatra from Nuvama. Please go ahead.
Yeah, thank you for the opportunity, sir. So I was asking that once these Bangalore and Pune malls are operational, so what kind of rents are we expecting from these malls?
Hi, Varun this side. So from Bangalore Mall, we are expecting average renters in the range of 150 to 160 rupees. So at 90% trading occupancy and when fully leased, we should see a rental income of about 180 crores. And Wakad Pune, we expect to see annual rental income of about 140 to 150 crores when fully leased and at 90% trading occupancy.
Okay. And second thing, what would be your total collections for this quarter?
Yeah. So from retail or
overall total?
Or assets combined?
All assets combined, if you can say.
Okay. So from retail, we have 540 crores. From residential, we have 129 crores. From hotels, we have 123 crores. And from commercial, we have 55 crores. So that takes it to about 850 crores for 3 months ended December 22. And for 9 months, we are at an aggregate of about 2,300 crores in collections from operations.
Okay. Okay, yeah. That's it from my side. Thank you.
Thank you. We'll take a last question from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thanks so much for the opportunity again. My question is, you're now 1 year into the lease renewal cycle, almost I think about 17-18% of the meaningful area uh, would have already been released and you would have had discussions. What kind of rental growth are you seeing in these releasing discussions or renewal discussions?
Puneet, sorry, just lost the last part of your question. If you could repeat that.
Yeah. So my question was, in these releasing discussions that would have happened in FY23, what kind of rental growth are you seeing in discussions, and if you can guide it to what do you see for 24 and 25 as well?
So typically we have seen approximately in the range of about 10 to 15% growth on minimum guarantee, depending on the category and the size of the store. So it's about 10 to 15% on the minimum guarantee, and plus there is an increase in revenue share as well that we have been negotiating. So again, varies from category to category. In fashion, we may see a 1.5% increase, 2% increase. Similarly in F&B as well.
Okay, that's it. That's all from my side. Thank you so much.
Thank you.
Thank you. As there are no further questions, I would now like to hand over the call to management for closing comments. Over to you, sir.
Thank you, ladies and gentlemen, for joining us today, and we look forward to our next interaction at the end of the last quarter. In the interim, if should you need any further information or assistance, please feel free to reach out to our IR team. Thank you very much.
Thank you. On behalf of the Phoenix Mills Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.